In every city, there are families doing everything they were told to do. They avoid big spending. They do not buy luxury items. They save every cent they can. Every month, they put money into accounts that seem safe. These are the things their parents called smart. But every year, these families fall further behind. This does not happen because they are lazy or unlucky. It happens because the things they call saving are not saving at all. They are traps. These traps use the language of wisdom to hide the fact that they steal wealth from people who cannot afford to lose it. If you feel like you are doing the right thing but still losing ground, this is the explanation. You need to understand one big point. There is a difference between storing money and growing money. Storing money feels like saving, but it is just delayed spending. Growing money is actual saving. Data from developed economies shows that families who escape poverty do not just store money. They use tools that grow their buying power. Others use tools that only look like savings while inflation eats the value. There are 12 things people call saving that actually make them poorer. First is the most common one. Cash in a standard savings account at a big bank. In May 2026, most big banks pay between 0.01% and 0.5% interest. Meanwhile, U.S. inflation is around 3% to 3.5%. This creates a gap of 2.5% to 3.5% every year. That gap is a guaranteed loss. If you have $100,000 in a bank account earning 0.5% while inflation is 3%, you lose about $2,500 in buying power every year. The number in your account stays the same, but the things you can buy with it shrink. Over 10 years, you lose $25,000. Low-income families suffer most because they trust these accounts. But Treasury direct accounts pay 4% to 4.3% right now. Anyone with the internet can set one up in 15 minutes. The same government guarantee exists, but the pay is much higher. Not knowing this costs a person $3,000 a year on a $100,000 balance. Second is keeping emergency funds in prepaid cards or check cashing accounts. Many people are unbanked. They use check cashing shops to get their money. These shops charge fees between 1% and 4% of the check value. On a $2,000 paycheck, that is $20 to $80 per check. If you get paid twice a month, you pay up to $1,920 a year just to touch your own money. Prepaid cards add more costs. They charge for monthly maintenance, ATM use, and reloading. These fees can cost another $600 a year. Money orders for rent and bills add a few more dollars. Altogether, staying outside the bank system can cost a household over $2,500 a year. This money leaves the home before they even try to save. It is a tax on the poor. People call this managing their money, but they are just paying a fee to an industry that profits from their exclusion. Third is the lottery. Every lottery board in the world markets tickets as a way to get ahead. In the U.S., the lottery makes $110 billion a year. Most of this comes from low-income homes. The average return on a ticket is 47 cents for every dollar spent. The state takes 30% and overhead takes another 10%. This means every dollar spent has a negative 50% return. No real investment is this bad. If a person spends $20 a week on tickets, they spend $1,040 a year. If they put that same money into a low-cost index fund at 7% for 30 years, it would grow to about $7,950. The buyer thinks they have a chance at a new life. The data says it is a $1,000 annual payment to the state. Fourth is paying off a car loan fast while keeping high-interest credit card debt. This happens when people try to feel progress. They focus on the car because it is a physical thing they own. But the credit card debt grows faster than the car loan shrinks. This mistake keeps families stuck in debt longer. Many people lack a clear plan to pay off debt. They follow a logic that feels right but fails in practice. A person might want to pay off their car loan first. They want to see a zero balance and stop that monthly payment. However, the math tells a different story. A car loan at 7% interest costs 7 cents per year for every dollar owed. A credit card at 22% costs 22 cents per year for every dollar. If you pay extra on the 7% loan while paying only the minimum on the 22% card, you lose 15 cents per dollar every year. On a $5,000 credit card balance, this mistake costs $750 in extra interest annually. Every dollar put toward the car loan instead of the credit card costs you the difference in interest. This is a wealth drain that adds up over several years. The rent-to-own industry builds billions of dollars on this same lack of math. People use these deals for furniture, electronics, and appliances. About 4.8 million Americans use these services every year. The Association of Progressive Rental Organizations shows that these deals often have effective annual interest rates between 80 and 300%. Look at a $600 television. A rent-to-own deal might cost $20 a week for 52 weeks. That totals $1,040. You pay a 40% premium for a TV that loses value the moment you take it home. The customer sees a way to get a TV without a big payment up front. The data shows they are paying huge markups for an item that drops in price quickly. Some people feel they are making progress by saving cash in a jar or an envelope. This system works well for budgeting and controlling daily spending. The danger starts when the envelope becomes the final place for savings. Cash at home earns 0% interest. It also loses value because of inflation. In 2020, $1,000 in an envelope had a certain buying power. By April 2026, that same cash only buys about $820 worth of goods. That is $180 gone. The money was not spent or lost. It just lost its power to buy things. People like seeing the cash because it feels real. This is a mental trap. Money in a Treasury direct account earning 4% grows. Money in an envelope shrinks every day. Credit card companies use reward points to make spending feel like saving. These programs are built to take money from the consumer. They are paid for by interchange fees charged to stores. Stores raise their prices to cover these fees. This means every customer pays more, even those using cash, to fund rewards for others. Rewards are just a small rebate of the extra cost built into every price. For people who carry a balance, the 20 to 24% interest costs far more than the rewards are worth. A person with 80,000 airline miles might think they have saved money. In reality, they have just delayed spending while paying high interest. Those 80,000 miles are worth about $800. If that person kept a $5,000 average balance at 22% for a year, they paid $1,100 in interest. They spent $1,100 to get $800 back. They lost $300 but call it saving. The payday loan industry runs on a simple trick. They let people borrow against a future paycheck to pay for bills today. They call this cash flow management. In 2023, these lenders made about $9 billion in fees in the U.S. A typical loan is $375. The fee is usually $55 for a 2-week period. That small fee means the annual percentage rate is about 380%. Poor families use these loans to survive until the next payday. They think they are managing their money. The data shows they are paying massive interest for short-term credit. Most borrowers roll over their loans 4 times. This means they pay $220 in fees just to get $375 for 2 months. That is a 59% cost for 60 days of credit. These loans target people with no savings. For them, $220 in fees is a huge part of their monthly income. Some people in South Asia, the Middle East, Africa, and Southeast Asia save money by buying gold jewelry. This is a deep cultural habit. Families pass gold down for generations. It feels like a safe bet because it is a physical asset. But the math is bad. When you buy jewelry from a store, you pay the gold price plus a making charge. This charge pays for the design and the store's profit. It adds 15 to 35% to the cost. When you sell the jewelry, you only get the melt value of the metal. The making charge disappears. You lose 15 to 35% of your money the moment you leave the store. A family that spends $10,000 on gold jewelry only has $6,500 to $8,500 in actual value. They lose up to $3,500 before they even wear the piece. Gold coins or bars from government mints do not have these charges. They track the real price of gold. Yet, jewelry is what is sold to the poorest families as a way to save. Multilevel marketing companies use a different trick. They call it inventory loading. They tell people they are building a business. In 2023, about 16.8 million Americans joined these MLMs. The Direct Selling Association and the FTC have the data. Over 99% of these people do not make a profit. They spend more on products to stay active than they ever earn. Someone who joins an MLM buys wholesale goods and hopes to sell them at retail. They also try to recruit new people. Most of the time, the retail sales never happen. The products sit in boxes in a garage. The money spent on them is gone. The person calls it an investment. The FTC calls it a negative return activity. Insurance companies also target low-income homes. They sell burial insurance and final expense policies. These are marketed to the elderly as a responsible way to cover funeral costs. They promise that the family will not be burdened by debt. The premiums for these plans are much higher than regular term life insurance. A 65-year-old paying for these policies pays a huge premium for a small amount of coverage. Consider a $10,000 final expense policy. These plans often cost between $80 and $150 every month. If you pay this for 10 years, you spend between $9,600 and $18,000. You pay almost as much as the payout, or even more, just to get $10,000 of coverage. This is a losing bet. You lose money even before you account for inflation. Most families buy these policies because they think it is the responsible thing to do. They want to make sure their kids do not have to pay for a funeral. A simple look at other insurance options proves this is a mistake. Healthy people can get the same death benefit through other tools for a small fraction of the cost. Term life insurance or simple savings plans often work better. This happens because of a hidden cycle. Most people get their financial tips from their own social circle. They talk to parents, aunts, or friends who are in the same money situation. This creates a cycle where people learn how to survive scarcity but not how to leave it. If your only teachers are struggling, you learn how to manage a small amount of money. You do not learn how to grow it. This explains why certain habits stick for generations. A grandparent might tell you to keep cash in a cookie jar. They did this because they lived through a bank collapse during the Great Depression. They stopped trusting banks, and that fear passed down to you. Lottery tickets become a habit when they feel like the only way to change your life. People see it as a cheap ticket to a better world. Multi-level marketing schemes look like a real business. A friend recruits you because they truly believe it works. They look like you and talk like you. Buying gold jewelry is another common tradition. For centuries, gold was the only safe way to store wealth before modern banks existed. None of these ideas are stupid. They make sense based on the lives of the people who started them. But they do not build wealth in 2026. Wealth today comes from tools that these social networks do not talk about. Families managing scarcity do not discuss low-cost index funds. They do not talk about treasury direct accounts or buying government bonds. They do not know about debt sequencing, which is a way to pay off loans to save hundreds in interest. This gap in knowledge is not about intelligence. It is about who you know. To fix it, you have to look for information outside your immediate circle. That is why the Wealth Files exists. These 12 common traps are not separate mistakes. They are one big mistake. People optimize for the feeling of comfort instead of actual growth. A savings account feels safe because the balance does not drop. Envelopes feel responsible because you can touch the cash. The lottery feels like hope. Jewelry looks like wealth. An MLM feels like being an entrepreneur because it uses the same words. These choices focus on a feeling, not a result. The gap between feeling responsible and actually being secure grows over time. This gap is the difference between independence and relying on others. These traps are not character flaws. They happen because the school system does not teach money skills to the people who need them most. Media companies make money by selling fear to the poor. The financial industry builds products that take money from people who lack a formal education. Understanding why this happens is the first step to changing it. You just need better information to make a different choice today. This is what the Wealth Files provides. Like and subscribe to keep getting this analysis. The patterns of the past are still moving, and the next lesson is already here.